Hello, I'm Chip Free with Lake Realty. A common question I'm hearing is, should I buy now or wait for interest rates to drop? There are several factors to consider, but ultimately it comes down to your comfort level. If the monthly payment doesn't feel right, waiting may be the best choice. However, if you're analyzing it strictly from a financial perspective, don't forget to account for home appreciation when you're crunching the numbers. Before diving into the numbers on home appreciation, let's talk about a similar concept regarding refinancing. The general idea is to refinance when your interest rate is at least 0.5% lower than your current rate. This is called your strike rate, and once you reach this rate, you should refinance immediately and not wait to see if they're going to drop another 0.25%. Let's break down the math on that. Take a $500,000 home with a 10% down payment, leaving you with a loan of $450,000. At 6.5% interest rate, your monthly payment, just principal, interest, and PMI, would be $3,031.81. If rates drop to 6%, that payment decreases to $2,885.48, saving you $146.33 a month. If you wait for another 0.25% drop and it takes you 6 months to get it, you're still paying the higher payment during that time. Over 6 months, you'd miss out on $877.98 in savings. So it would take over a year to break even at the lower rate. Meaning it's usually better to refinance as soon as rates drop 0.5%, and if rates drop another 0.5% later, you can refinance again for even more savings. Now, back to running the numbers on home appreciation. Let's assume you're looking at a $500,000 home with 10% down and a 6.25% interest rate. Your monthly payment would be $2,958.23. Again, just principal, interest, and PMI. You may want to wait for rates to drop to 5.75, but we need to factor in home appreciation into that decision. In the Charlotte market, we've averaged around 9% home appreciation over the past 5 years and between 5 and 7% in 2023. Let's assume 5% home appreciation. At a 5% appreciation rate, that $500,000 home will cost $525,000 in a year. With the same 10% down, you'll pay an additional $2,500 out of pocket, leaving you a loan amount of $472,500. At 5.75% rate, your new monthly payment would be $2,954.26, just $3.97 less than if you bought now at $500,000. By purchasing now, not only would you look at a lower price, but you'd also gain $25,000 in equity over the year. On top of that, you'd be able to drop PMI earlier because you would have made 12 payments equaling $5,272.88 of principal reduction, plus the $25,000 in equity, leaving you a loan-to-value ratio of 84.71% compared to 90% if you bought a year from now. Overall, waiting for lower rates may not save you as much when you factor in home appreciation, in addition to how it impacts your equity and PMI removal. Another wrinkle to think about is when rates drop below 6%, buyer demand may pick up, and that will result in more competition. So, whether to buy now or later depends on so many variables specific to you and your situation, and you should make that decision when you are ready. I just encourage you to run the numbers if interest rates are a big part of that decision. I did want to add this discussion of home appreciation is based on home prices rising. If you didn't see my last video on that topic, I left a link to it in the description below. Well, that's it for this one. I'll see you next time. Thanks.